Hi traders, you're welcome to the Forex Geek channel. And in this video, we are just going to break down one of the most important concepts in smart money trading, and that is the ICT Liquidity Voids. Okay, so in case of if this concept is new to you, I have to start with explaining what liquidity voids are. Okay, simply put, a liquidity void is an area on the chart where price moves rapidly in one direction, leaving behind little to no trading activity. Okay, so these often show up as big impulsive candles. For example, you can see what we saw happen here, right? So it often shows up as big impulsive candles, and they shoot up if it is a bullish candle, or shoot down, if it is a bearish candle, without much overlap. They are also known as imbalances. All right, now why are liquidity voids important? The answer lies in how institutional traders operate. Okay, when large players push price aggressively, they create these gaps in price action. Okay, um but because so little trading actually happened in that area, the market often comes back later to rebalance and fill that void. Okay, so you can see that we actually had an imbalance here. We had a gap. You see, in this area of imbalance, you can see that eventually the price came back to fill that void. So this is why liquidity voids often act like magnets. Price is drawn back to them. Now let us walk through how to identify them on your chart. The first step is to look for impulsive candles, long impulsive candles like this example, with little to no wick coverage, in the opposite direction. All right. Then the second step is to mark the start and the end of that candle range. Okay. So we have already used, okay, let me just, to make this more, so we are using a rectangle to mark this, right? So you should actually mark the range, the top and the bottom of the candle. All right, so once you have marked the start and the end, the, okay, so you identify your liquidity void. Ensure that you um also mark out the gap in between the previous candle's high and the next candle's low. Okay, that's if it's a bullish candle. If it was a bearish candle like what we have here, if it's a bearish candle like what we have here, what you would be looking to mark is, the gap between the previous candle's low and the next candle's high, right? So after you've identified these things, you need to observe how price behaves when it returns to that level. All right, watch out for how price behaves when it returns to that level. More often than not, price retraces to fill that imbalance before continuing its next move. So you can see that in this particular example, this bearish example, you can see price came back to fill this imbalance, right? And even in the bullish example, you can see price still came back to fill that imbalance. So these are two examples that are close to each other, that price eventually came back to fill the imbalances. Okay, but here's where it gets really interesting. Liquidity voids don't work in isolation. They become far more powerful when combined with market structure, liquidity grabs, and other blocks. Okay, for example, if you see a breaker block forming near a liquidity void, that is a strong confirmation that institutions are active in that area. All right. Now, another key point is timing. Not every void will get filled immediately. Okay, sometimes price will leave multiple imbalances behind before eventually retracing to clean them up. This is why patience and context are crucial. Liquidity voids are part of a bigger puzzle. They are clues left by smart money that give you a glimpse into how price is engineered. So by practicing this concept, you'll start to see patterns that most retail traders completely miss. Instead of guessing where price might go, you'll have a logical reason for why price is drawn to certain levels and why it reacts the way it does. So to recap, liquidity voids are areas of imbalance created by aggressive moves in the market. Okay, with little trading activity. All right, you can identify them. It's easy to identify them. They're important because price often returns to fill them. You can identify them by spotting impulsive moves with little trading activity, marking them out and watching how price reacts when it comes back. Meanwhile, you should combine them with overall market structure for the best results. Okay, you should not neglect market structure even when paying attention to the liquidity void. And when you are trading, perhaps if you were trying to catch the move to fill up the void, make sure that you always employ proper risk management, because one of the strategies that you can use for this liquidity void concept is to try to catch the move to fill up that void. All right, but like I said, you should pay attention to market structure. Let's just use this as an example. As price came to test this particular support level, right, perhaps considering the fact that you're expecting price to fill up this void, you can look for a good entry point, get confirmation, actually get confirmation, and then look for a good buy opportunity to enter a buy trade, and then you set your stop loss appropriately, and then you can just target the end of this liquidity void to take profit. Then in the case of this sell, you look for this particular liquidity void that which a sell trade is going to fill up. You look for an opportunity. Probably from the onset, you can just start finding opportunities to sell. Although this would have been an opportunity, but if you had entered here, you would have gotten stopped out. Okay, but of course we have to be realistic. Yeah, most likely we would have taken a sell around here, but eventually we would have gotten stopped out. But then there was another sell opportunity. I'm trying to see if there was a reference for this. Okay, trying to see if there's a reference, because you have to sell at important zones, right? You have to sell at important zone. Okay, you can see that we actually had a resistance zone around here. So this was another uh, place to sell. And then if we had gotten stopped out here and then sold here, then this one would have given us some profit to fill up this void. However, take note that not every liquidity void might end up getting filled. Okay, so if your strategy is based on filling up liquidity void, you have to be careful, because sometimes there could be a situation whereby a void might not get filled anytime soon. So you might take a while before the void gets filled. So your strategy should not just depend on this filling of liquidity void alone. All right, so if this explanation of the ICT liquidity voids helped you see the market in a new way, make sure to hit the like button, subscribe to the channel, and turn on notifications. That way you will never miss future breakdowns of smart money concepts. And remember, the more you study liquidity voids in past charts, the more you'll start to see how they shape the market. The footprints of institutions are always there. You just need to know where to look. Thank you for watching. I'll see you in the next video.